Hi, welcome back to Compounded Daily. In the previous video, I gave a brief overview of discounted cash flow. Check out that video to learn more. In this video, I'll be going more in depth into discounted cash flows, as well as covering a closely related concept known as net present value, or NPV. So in the previous video, we defined NPV as the difference between the discounted cash flow and the initial investment. To be more exact, the net present value of an investment is the present value of its cash inflows minus the present value of its cash outflows or costs. We use the word net because we're subtracting the present value of the outflows or costs from the present value of the inflows. To put it another way, the net present value can be calculated as the present value of all cash flows for the life of the project less the initial investment or outlay. So one way you can define the NPV is today's value of the expected cash flows minus today's value of invested cash. Remember, in net present value, what we are subtracting are present values of cash flows, not the cash flows themselves. The expected future cash flows need to be discounted in order to determine their present value due to the time value of money, which is an idea we briefly discussed in the previous video. Basically, the time value of money is the idea that $1 today is worth more than $1 in the future. One reason for this is that inflation erodes the value of money over time. It's interesting to note that there is no discount factor for the initial outlays, which are the initial upfront time zero costs, because they occur before any time has passed, i.e. in year zero. If you think about it, if we look at the discounted cash flow formula for the initial outlay, the exponent will be zero. Moreover, anything to the power of zero is 1. Furthermore, anything divided by 1 is equal to itself. So even if you were to discount it, the initial outlay would remain the same. It's also important to notice that the further away from year zero the cash inflow is, the more it gets discounted. That's because the exponent is larger. The bigger the exponent is, the bigger the denominator. And the bigger the denominator, the smaller the quotient. And the smaller the quotient, the more the cash flow gets discounted. So that's why the further away the cash inflow is from today, the more it gets discounted. This is because the more time that passes, the more it loses value due to the time value of money. Now, you may also see the NPV formula shown like this. This is called summation notation or sigma notation because of the Greek letter sigma. Sigma is used to write out a long sum like our net present value formula in a concise way. Even though they are written differently, they do the exact same thing. Just like before, R is our discount rate, N is the number of periods or years if cash flows are annual of cash flows we are considering, and CF sub T is the cash flow at the period T. So what sigma tells us is that we're summing something. In this case, we are summing the discounted cash flows. To be more exact, we're summing the present values of all cash flows, inflows and outflows, which gives us the investment's net present value. So we start at the bottom number and end at the top number. Basically, we substitute each number in that interval into the expression and add up the resulting terms. So we end up with our original formula. In this case, our cash flow at t equals 0 or year zero is just going to be our initial outlay, which is negative since it's a cash outflow or cost as opposed to a cash inflow. So our original formula is all contained in the sigma notation. Cash flows that have a positive sign are called inflows and increase NPV, whereas cash flows that have a negative sign are called outflows and decrease NPV. Okay, so now how do we determine the discount rate, or R? So R is the required rate of return. We can also think of R as a financing cost or a cost of capital. For instance, the weighted average cost of capital, or WACC, is often used to discount cash flows in capital budgeting. Alternatively, you can define R as the opportunity cost of capital, which is the alternative return that investors forgo in undertaking the investment. For example, let's say an investor could receive $100 today or a year from now. Most investors would not be willing to postpone receiving $100 today. However, what if an investor could choose to receive $100 today or $105 in 1 year? The 5% rate of return might be worthwhile if comparable investments of equal risk offered less over the same period. If, on the other hand, an investor could earn 8% with no risk over the next year, then the offer of $105 in a year would not suffice. In this case, 8% would be the discount rate. In summary, future cash flows must be discounted using the discount rate because time must pass before they're realized, the time during which a comparable sum could earn interest. Okay, so now let's look at an example. Suppose you are reviewing a proposal that requires an initial outlay of $2 million. So the cash flow at time zero would be negative $2 million. You expect that the proposed investment will generate net positive cash flows of $0.5 million at the end of year one, $0.75 million at the end of year two, and $1.35 million at the end of year three. Using 10% as a discount rate, you calculate the NPV as follows. Because the NPV of $88,655 is positive, we can accept the proposal. To be more precise, a positive NPV indicates that the projected earnings generated by a project or investment, discounted to their present value, exceed the anticipated costs, also in today's dollars. So we can assume that this investment will be profitable, therefore adding shareholder value, and is therefore worth undertaking. NPV is important because it's arguably one of the best methods to evaluate capital budgeting projects. However, a notable limitation of NPV analysis is that it makes assumptions about future events that may not prove correct. The discount rate value used is also a judgment call, while the cost of an investment and its projected returns are necessarily estimates. So the NPV calculation is only as reliable as its underlying assumptions. With that being said, I hope you enjoyed the video. If you liked the video, feel free to like and subscribe. This has been Compounded Daily. Thank you for watching and have a great day.